There you have it, today's closing bell at the New York Stock Exchange.
It was a rough one for the markets in the wake of the Credit Suisse situation in Europe. At one point today, the Dow Jones was down around 700 points. The industrials finished the day down about 300 points. The S&P 500 and NASDAQ also closed in the red. The S&P down more than 1%, and the NASDAQ is down by less than 0.5%.
We're joined now by J.D. Durkin. J.D. is the host of The Street, and he joins us from the floor of the New York Stock Exchange. So, J.D., the market fell sharply today when shares of Swiss bank Credit Suisse plummeted. What drove that slide?
I absolutely. I mean, thank you for having me first and foremost. This kind of goes back to the challenge that we've been having from Silicon Valley Bank this time last week, where perceptions of instability or volatility in the banking sector are undoubtedly going to work themselves into other big names as well. So, just as we were kind of coming out of the dust settling a little bit from SVB, we enjoyed a really nice relief rally across the major market indexes yesterday. We had this kind of hypothetical question and answer from the largest shareholder of Credit Suisse, the Saudi National Bank, and that bank's chairman, who was asked in a simple hypothetical: if Credit Suisse faces a liquidity crunch, would you be there to assist? No reason to think that the bank would actually have been there, to which the chairman responded, absolutely not. That would increase our ownership stake, and we don't want to be subject to more regulations. Hypothetical question, hypothetical answer, the conversation continued. The problem is investors in Credit Suisse, because everyone is so jumpy right now with these knee-jerk reactions, right? They really took that as a sign that maybe Credit Suisse wouldn't be bailed out by their largest shareholder. As financials go, so go a lot of the other sectors. That helps explain why we had such aggressive selling into today. That was true for especially the Dow and for many sectors in the S&P 500 as well.
Yeah, JD, isn't it? It's always so striking how these hypothetical situations can have very real implications when it comes to the market. I'm wondering what today's action means for the already fragile banking industry, especially as we're discussing when perception leads to, in some cases, self-fulfilling prophecies.
Self-fulfilling prophecy is the phrase to use. There's absolutely no doubt about it, because, again, yes, SVB last week was uniquely exposed in terms of its depositors and its client banks. These are technology, IT companies. We know that a lot of those names are struggling with a high interest rate environment. But otherwise, look, the government came in on Sunday night here in the U.S., the FDIC, the Treasury, the Fed. The backstop worked. We got reports here in the last 30 minutes or so of the Swiss National Bank saying similar backstop measures would be put in place to protect depositors for Credit Suisse. But because you are dealing with the first real banking crisis since what people call the GFC, or the Great Financial Crisis of 2008, there's going to be a lot of trepidation about where we go from here. And I think that really underscores the importance of tomorrow's decision from the European Central Bank about how aggressively they will raise rates in their effort to fight inflation. And especially this time next week, my goodness, all eyes will be on Jay Powell and the Fed as we get our own interest rate for the March FOMC decision and what they choose to do from here.
Exactly.
It's very tough for the Fed. They need to stabilize prices. They need to maximize employment. But people say the high interest rate environment right now is a big challenge for a lot of these banks.
So, JD, I want to follow up with you on that point, because I want to try and make this as simple as possible. But as long as the Fed continues to raise interest rates, it means that these banks are going to have on their balance sheets 30-year loans that they have already promised that are at a lower rate of lending that they're now going to have the ability to make back from other depositors. How is this potentially going to impact what Jay Powell decides when it comes to weighing the need to bring down inflation, to calm the economy, with the need to try and buttress these banks' balance sheets when they're deciding on these Federal Reserve rates?
It is absolutely it's a really fair question. And it's a challenge. You're right. In a current high interest rate environment, previously issued bonds are devalued. You get less of a yield. It's less of an attractive investment. So today, as interest rates are high, if you're a bank or you're an individual, you're trying to sell a previously issued bond, you need to take a loss at that. That's what got Silicon Valley Bank into this challenge in the first place. More directly to your question, I believe you have to take Fed officials at their word. The thing that Chairman Powell has said over and over again since March of last year, we cannot allow inflation to become too deeply entrenched. we basically have one tool in the toolbox: continue to raise short-term interest rates. And I think if you're Chair Powell, you're inclined to say, look, the backstop worked. We came in Friday. We did what we were supposed to do. There were guardrails put in place after the great financial crisis. And while there may have been bad decision-making by executives at a bank like SVB, ultimately, customers and depositors were made whole. The system works. There's a big debate right now about how aggressively, and I'm looking at the numbers, about how aggressively the Fed will raise rates next week. Some people bet it's going to be 0 or only 25 basis points. This time last week, everyone seemed to think it would be as high as 50 basis points. Every time you turn around, that bet is slowly changing. I think the safe assumption is you have to take Fed officials at their word. Another increase of 25 basis points or 0.25% to the federal funds rate is most likely. And as a reminder to people watching at home, as that interest rate goes up, you pay more on that month-to-month credit card balance, some auto loans, your mortgage as well, if it applies. So this underscores the importance. If you have that credit card balance, now is really a great time to try and pay it off.
Right. So against that backdrop, JD, British Finance Minister Jeremy Hunt said the UK will not hit a recession this year as expected. The question for us here is, what does that mean with the United States here and recession fears? Because this is something that we had been talking about last year, the early part of this year. Now, with this very complex situation unfolding, and we see this kind of fear, not just in the United States, but overseas as well, with so much uncertainty, where does the U.S. stand when it comes to a recession?
Well, it's interesting. I think the economist who recently coined the phrase "no landing," we talked about a soft landing for some time. The economist who recently coined the phrase "no landing" has now said that idea is out the door. I think it's confidence we are heading towards a recession. If you ask 5 different economists right now whether or not they think there's going to be a recession, you'll get more than 5 answers about what the potential outcome is. Fed officials up until now have been very clear and communicative. They say we can raise interest rates slowly, steadily. We can bring inflation back down to our goal of 2% without necessarily putting the United States in a recessionary environment. But right now, everyone's trying to react to the data, and anyone's guess is as good as yours or mine about where we go from here. We are seeing those layoffs in the tech sector, in media companies as well. We're just not seeing that budge yet into things like food and hospitality.
Hey, JD, real quick, before I let you go, there's a lot of talk, especially here in the United States, about regional banks. People maybe thinking that their money is going to be more secure in a bigger bank, though the FDIC insures everybody at the same level, whether it's a small bank or a big bank, if they're FDIC insured. What is the problem if we see more regional banks start to lose customers? And is there a concern there on the street about everybody moving to these big banks exclusively?
I think if there is a concern to the big banks, it's because a bigger bank like a Citigroup or a Citibank, a JP Morgan Chase, a Wells Fargo, they have additional regulations on them that many regional banks really don't have. So even though the environment is challenging for regional banks, there is an open call to Americans to say, now is not the time to panic. Now is not the time to have a Jimmy Stewart-style bank run, the likes of which we saw at SVB into last week. Now is the time to be stable. I think that's why the White House rolled out President Biden Monday morning as markets were opening to quell a lot of those concerns. But the bank stocks for regional names are really getting hit. First Republic here in New York down 17% on the day, whereas if you compare it to some of the big banks, they were still down quite a bit to 3 to 5%. But you're really seeing those regional names get hit. But most people you talk to will say now is not the time for concern. Have confidence in the system. We've heard that from Fed officials and from the White House in recent days as well.
All right, JD Durkin. JD, thank you.